Welcome back. In this, my last session on the data that I collected for 2018, I want to talk about the pricing of companies. Let me backtrack. In my first 8 posts or sessions about my data, I talked about what's different about 2018, what the data tells me about companies. And I found that prices of risk in both the equity and the bond markets have gone up. The equity risk premium, the default spreads, and as a consequence, companies are seeing increasing or higher costs of equity and capital. I also found that companies are having a tough time finding good investments. If you define good as investments that make a return greater than the cost of equity or capital. And thirdly, I found that companies are returning increasing amounts of cash back to stockholders, and a large chunk of that cash is taking the form of buybacks. Now, along the way, though, I did not talk about the pricing of these companies. And in this session, I want to fill in that gap. Now, before I talk about how companies are being priced around the world, I want to draw a contrast between two words we use interchangeably, and I think mistakenly: value and price. We know what drives the value of a company. It's its expected cash flows, its growth, and its risk. You might use a discounted cash flow valuation to capture those variables, but ultimately the drivers of value have always been the same: cash flows, growth, and risk. We know what drives the price of a company. It's demand and supply. Now, in a perfect world, a rational world, you'd say demand and supply should be driven by fundamentals, but we don't live in a perfect world. We know that demand and supply are also affected by non-fundamental variables, by mood, by momentum. And if you're asked to price a company or price a stock, the way you do it is by looking for similar stocks out there and seeing how they're priced. So when you use multiples, a PE ratio or an EV to EBITDA and comparables, you're not valuing a company, you're pricing the company. So the value process comes from cash flows, growth, and risk. The pricing process reflects demand and supply with all of the variables that go into demand and supply. Now, the difference, if there is one between the two numbers, let's call it the gap. And the reason I like this picture is kind of encapsulates all those different investment philosophies out there. For instance, if you believe in efficient markets, here's how you see the processes playing out. You believe that the value and the pricing process yield numbers that are roughly the same. And that when there's a difference, the difference is both random and transitory. Random in the sense that you cannot find it using any techniques, and transitory in the sense it closes quickly. Now, if you're an investor, you value a company, and then you compare to the price, and you believe the two can be different, and then you hold on to the stock expecting the gap to close. That's true whether you're a value investor or a growth investor. The only difference between the two of you is where you think markets make their mistakes. So investors value companies, and if the price is different, they expect the gap to close and to make money. If you're a trader, you either believe there's no such thing as value or intrinsic value, or that you really cannot estimate it even if it exists. So you say, why bother? So you view your game as buying at a low price and selling at a high price. So you're essentially entirely focused on pricing. I don't have a problem with any of these philosophies. In fact, there are people who fall into each of these three groups. That said, though, I think the real danger here is being delusional. Delusional in what sense? When you come to play one game, but you talk a different game. For instance, a portfolio manager who claims to be a value investor, but then if you look at their portfolio, it's composed almost entirely of momentum stocks or stocks picked by screening based on PE ratios. If you're playing the pricing game and talking the value game, you're being delusional, and that's a problem. Alternatively, you could be a trader who picks stocks based on technical indicators and charts, but you do it in the closet. Outside, though, you talk about cash flows and growth and risk. That's delusion as well. If you're going to play the pricing game, play the pricing game. If you're going to play the value game, play the value game. There's nothing good or bad about either game. What gets you into trouble is when you're playing the wrong game, or you're playing a game that you did not come to play. With that set up, let me take a closer look at the pricing process. If I'm asked to price a stock, here's the three-step process. First, I cannot compare price per share across companies. You're saying, why not? Because in a sense, it's arbitrary. If I look at just price per share, Berkshire Hathaway is the most expensive stock in the market. Why? Because it trades at a 6-digit number. A penny stock that trades at a penny is really cheap, right? That's absurd, you're saying. You're right, it's absurd. And that's why we divide the market price by something, by earnings, by cash flows, by book value, by revenues. A multiple is just a scale price. So the first step in pricing is picking that scaling for the pricing. What multiple are you going to use? Second stop, you have to find similar companies out there. And here again, you got to make some judgments. If you have a large US steel company, are you going to look for other large steel companies? Are you going to look at all steel companies? You're going to look at only US companies? You're going to look at global companies? Are you going to expand to manufacturing companies? You can already see that this is a subjective judgment as well, but that's the second step. And the third step is after you've got a multiple, let's say PE ratios, and you've looked at 15 steel companies, and you're trying to price your steel company, you have to look at differences between your company and your peer group. Maybe it has higher growth or lower risk and factor that into the pricing. Find a multiple, find a peer group, control for differences. That's the essence of pricing. So rather than talk in abstractions, I'm going to take the data on pricing from 2019 and lay out the data in the form of 5 lessons that I learned by looking at the data. The first is price is relative. Having absolute rules of thumb, where you say a stock that trades at a PE ratio less than 10 and EV to EBITDA less than 6 is cheap, makes no sense if you live in a relative world. Second, markets do share a great deal in common, more than we think, but the differences can also be revealing, and if you ignore them, dangerous. Third, I think book value is the most overrated metric in investing, and I'm going to talk about why and what the data tells us about book value. Fourth, most stocks that look cheap deserve to be cheap. When you're pricing and you're trying to find investments, you're trying to pick stocks based on pricing, you're trying to find stocks that look cheap but don't have a good reason for being cheap. And finally, in pricing, it's what gets priced in that matters, not what you think should be priced in. And again, this sounds abstract, but I'll come back and back it up. Let's start with the first of these propositions. If you live in a pricing world, there is no room for absolute rules of thumb. So I use the example of a PE ratio less than 10 being cheap. I'm not sure what the source of this rule is and when it was founded. But if you ask me, is a PE ratio of 10 low? The way I answer is by looking at the data. So in this graph, for instance, I have a histogram of US stocks, or PE ratios for US stocks. What's a histogram? I just count the stocks, PE ratio 0 to 4, 4 to 8. It's not rocket science. And I also look at the distribution of PE ratios. How does that help me? Well, if you look at the distribution for trailing PE, so let's say that's what you're basing this 10 times PE rule on. Well, a PE ratio of 10 would put you at the 25th percentile. What does that mean? 25% of all US stocks have PE ratios less than 10. If that's your definition of cheap, that's good. But if you wanted something more stringent, then you can't pick 10 as your basis. In fact, if you think I'm picking just on value investors, I'll expand my criticism. I've heard LBO originators argue that if a stock trades at less than 6 times EBITDA, it must be cheap. To counter that, I've looked at a histogram of EV to EBITDA multiples, not just for US stocks, but around the world. Is 6 times EBITDA cheap? Well, maybe in the US it works because about 13 or 14% of stocks trade at less than 6 times EBITDA. But if I use 6 times EBITDA as cheap, I'm going to find a lot of cheap stocks in Russia and Eastern Europe and Africa. And that might not be cheap in those markets. So what am I trying to say? Well, if you're going to use a rule of thumb and you have the data, wouldn't it make more sense to have the rule of thumb instead of being absolute, be dynamic? What if you define your rule of thumb as the first decile? You're saying, I'm going to look at the first decile, and based on that, a stock that has an EV to EBITDA less than 5.16 is cheap in the US. But if I'm looking at global stocks, its EV to EBITDA has to be less than 3.82. We have the data now to have rules of thumb that are dynamic and adjust to the data, and we should use them. Now, the second thing is as we get more global, you have two extremes. One group still stays local. So I've gone into emerging markets where people are so convinced that their market is so unique, so different, that none of the rules that apply in other markets apply to them. So this is often true whether you go to India, Brazil, or Indonesia. People are so convinced that the Indian market, the Brazilian market, the local market is so different that nothing that happens in developed markets apply to them. That is not true. And you can see this if you look at the distribution of any multiple, in this case, PE ratios around the globe. So this is different parts of the world on the same distribution. Notice how all the distributions share the same characteristic. You're saying, what are you talking about? The peak is to the left, the tail is to the right. What does that mean? Well, PE ratios are asymmetric all over the world. And the reason for it is very simple. A PE ratio can never be less than 0, but it can be 10,000, 5,000, 15,000. Still, you might wonder, so what? Notice how many rules of thumb are based on averages. A stock is cheap because it trades at less than the average PE for the sector. When you have an asymmetric distribution, averages can be misleading because they get pulled out by the outliers, which in this case are all big positive numbers. That is why I focus so much more on the median when I look at PE ratios. And when you look at the median PE ratio across regions, you notice that the other extreme, which is global portfolio managers who are now convinced that they live in a global world and don't have to worry about where a company is traded, are also wrong. Because if I pick stocks based just on low PE ratios, guess what kinds of companies I'm going to end up with in my portfolio? I'm going to end up with a lot of African stocks and Middle Eastern stocks and Russian stocks because that's where you see the stocks with the lowest PE ratios. So it's true that there is convergence in the world, that there's a lot more that markets around the world share a lot more in common, but the differences are still there and we have to notice them and bring them into our investment strategies. Third, book value, I think, is the most overrated metric in investing. Notice how many decision rules and investment. In fact, I think it's embedded in investing that if a stock trades at less than book value, it must be cheap. What is the basis for this? I think there are two assumptions that drive this trust in book value. One is the notion that book value is somehow a measure of liquidation value, that if you sold the company today, you'd get the book value back. The other is that you trust accountants. Accountants are consistent and they're conservative. So if there's a book value, it must mean that it's a good estimate of the value of the company. I think those assumptions are built on sand because neither assumption holds up. First is book value is not a measure of liquidation value. There might be a few sectors, maybe in financial services, where your assets are financial assets and mark to market, where book value actually means something. But in most sectors, book value is not a good proxy for liquidation value. And I don't trust accountants to be consistent. In fact, we know accountants are not consistent the way they apply rules. That what gets called book value for a manufacturing company is not comparable to the book value for a technology company. And accountants, I don't think, are conservative as much as they're late to the party. They're late to adjust their numbers to what's happening in the real world. So to take a look at book value, here's what I did. I looked at the price to book ratios, again, across the globe. And with each part of the world, I also computed the percentage of companies that traded below book value. Again, let's take the rule of thumb. A stock that trades at less than book value is cheap, right? In the US, that would mean 1/4 of all stocks, which is a large number, would be cheap. But there are parts of the world where more than half of all stocks trade at less than book value. And those parts, I think you'll see some familiar regions pop up. Africa, Middle East, Eastern Europe, and Russia show up again. Now, to see why it's so dangerous to base your decisions based purely on book value, let me take another cut at the data. I took US stocks and broke them down by industries, and I looked for the 10 industries that have the fewest stocks that traded below book value, and the 10 industries where you see the most stocks. Take a look at both lists. When you look at the list of industries where the fewest companies traded below book value, they tend to be dominated by technology and consumer products. Both sectors where accountants have not been very good about bringing the assets onto the book. So maybe the problem here is book value doesn't actually capture what's invested in these companies. You do have a couple of surprises, right? You've got utilities there and basic chemicals. But for the most part, you can see why the industries which have the highest price to book ratios have those numbers. If you look at those industries where you have the most stocks that traded below book value, you see them dominated by natural resource companies, primarily oil companies at every part of the oil business. Now, you also tend to find in other words, you find capital intensive companies, many of them aging, some of them declining, show up as companies that look cheap on a price to book basis. So what does it mean? If you go out and pick stocks based just on low price to book ratios, you're going to end up with companies that are dominated by these sectors, capital intensive, declining businesses. And I'm not sure that's a great investment portfolio to hold for the long term. Fourth proposition about pricing. Most stocks that look cheap deserve to be cheap. One of the first things I do when I'm given a multiple is I look for the variables that should drive that multiple. Perhaps it's my intrinsic value roots speaking up. So let's say you give me price to book and say, what are the variables that should drive price to book, that explain difference in price to book? Here's what I'm going to do. I'm going to go back to the simplest equity valuation model I can think of, a stable growth dividend discount model. And then I'm going to do some algebra. I'm going to divide both sides of that stable growth dividend discount model with the book value of equity. I'm going to end up with an equation for the price to book ratio. And here's the magic. The minute I do that, I have the four variables that drive price to book. And here's what they are. The return equity of the company, the risk of the company captured through its cost of equity, the growth in the company, and the payout ratio. So I can go further. Stocks with with high returns on equity and high growth should trade at higher price to book ratios, and companies with higher risk should trade at lower price to book ratios. Not only can I tell you the variables that drive price to book, but the direction of the relationship. You give me EV to sales, here's what I'm going to do. I'm going to go back to the simplest enterprise value model that I can think of, a stable growth firm valuation model. Do the algebra, divide both sides by sales, and have the variables that drive the enterprise value to sales ratio. It's operating margin, their reinvestment, how much they have to put back into the business to create the growth, their growth rate, and the risk captured in the cost of capital. The variables that drive multiples are right there in front of us if we're willing to look. And I say, how is this useful if my job is pricing? If your job is pricing, it behooves you to bring in these fundamentals. In other words, if you want to find cheap stocks based on PE ratios, don't just pick stocks with low PEs. You want to find stocks which have low PE ratios which don't have good reasons for those PE ratios to be low. Like what? You want a stock with a low PE, but you also want a stock with high growth, low risk, and a high return equity. You're saying, what harm? No, what chance do I have of finding something like that? No harm looking, right? The essence of pricing is to look for mismatches. In this table, I've listed the mismatches that would give me cheap stocks. A low PE stock with a high growth rate, a low price to book stock with a high return equity, a stock that trades at a low multiple of revenues while having a high margin. You might find these stocks, these mismatches. I'm not suggesting that all of them are going to be great investments, but if you're trading, that's what you're looking for. Which brings me to my final point. If your job is pricing, you're a banker, you're an analyst, then you have to focus on what's being priced in rather than what you think should be priced in. For the most part, though, you're right. Company markets do price in what makes sense. In other words, most stocks with low returns on equity have low price to book ratios, low growth, and low PE ratios. But sometimes an entire sector, entire group of companies, the pricing is driven by something else. And rather than be mysterious, let me be specific. Let's suppose you have a sector where almost all of the companies are young companies early in the life cycle. What does that mean? They have very little in revenues, they're losing money, their book value is either non-existent or negative. None of the traditional metrics are going to work for you, right? PE ratios won't work, book value multiples will not work, even revenue multiples you might be able to compute, but they're numbers like 70 times revenues, 100 times revenues. You're desperate. And what do desperate people do? They look for something else to scale the pricing to. What could that be? Well, in the dot-com era, the late 90s, it was website visitors. In the early stages of the social media boom, when social media companies were getting listed, it was number of users. And in the later stages of the subscriber business, it's market value per subscriber. In other words, you're dividing market pricing by one of those metrics. Your first reaction to that might be, that's dangerous, you shouldn't do it. But if your job is pricing, you got to do what you have to do. So let me give you an example. In 2013, when Twitter went public, I valued Twitter using a traditional intrinsic value model and came up with a discounted cash flow value. The value that I got per share was about $17 to $18 per share, about 11 billion. Then I tried to price Twitter. To price Twitter, here's what I did. I took the social media companies that were public right then, and I looked to see what the market was pricing in. The way I did this was I looked at the market capitalization of these companies and looked to see what variable best explained those differences in market cap. And I noticed it wasn't revenues, wasn't growth, it wasn't cash flows, it was number of users. In fact, the market was paying roughly $100 to $130 per user for these companies. I took Twitter's 240 million users, I multiplied by 100 to 130, and I ended up with a pricing for Twitter between 24 to 30 billion. You see, that is so unsophisticated and so unscientific. Guilty as charged, but your job in pricing is to reflect what the market is pricing in. So if you were the banker taking Twitter public in 2013 and you'd done this and you told me you did this, who am I to tell you that you're wrong? Your job is pricing, you've done your job. You know what I have a problem with is if you show me a discounted cash flow model and claim that your $24 to $30 billion value came from that discounted cash flow model. At least be honest with your pricing and tell me what you're pricing your company on. So here's my bottom line. I'm a believer in intrinsic value and I am more investor than trader. But I'm not going to tell you you're wrong if you're a pricer. If you're building your investments based on, or you're making your choices based upon a multiple and comparables, or even charts and technical indicators. I don't own the one righteous path to making money. In fact, the end game for both of us is to make money. If you make money by looking at charts and I make money with discounted cash flow models, who am I to claim that my money is more righteous, better earned than yours? We have to play the game we came to play. If your game is the pricing game, play the game. Play it openly, play it without shame. There's no shame in being a trader if you're willing to be open about the process by which you trade. So, my pushback on pricing is not that you shouldn't do it. I think it's perfectly okay to price companies. It's just don't be sloppy. Don't use averages, don't throw away data. We have the data to do pricing better, and we should use it. And if that's a lesson you get out of this session, I think it's a lesson worth remembering. So, thank you very much for listening, and I hope to see you soon.